Seminar 3, Financial Analysis, Horizontal and Vertical Analysis. Financial analysts or financial managers use horizontal and vertical analysis to see the change over a period of time. So a horizontal analysis, also known as a trend analysis, allows assessment of relative changes in different items over time. It also indicates the behavior of revenues and expenses, as well as other line items. It shows a company the change in dollars and the percentage over a course of time. The change in dollars and percentages helps the financial analyst to zero in on the key factors that affected the profitability or financial position. So calculation for difference. Okay, so the oldest year is the base year. For example, if years 2013 and 2014 is presented in the financials, 2013 is the oldest year, and that's your base year. You're going to subtract the oldest year from the newest year and then divide the difference by the oldest year. So here's an example. So for 2014, whatever my line item is, it was 1,265. 2013 was 1,123. And 2013 is going to be my base year because it's the oldest year. So I'm going to take 1,265 minus my 1,123, and I get 142. And I'm going to take that 142 and I'm going to divide it by the base year, which is 2013, and it's going to give me 12.6%. So let's look at an example. So this is an income statement. I just made it up. So I have revenues. Okay, so I have sales revenues minus my sales return allowances, and I have my net sales. So if you see in 2014, I had sales revenue of $36,000. 2013, it was $30,000. So it was a difference of $6,000, or an increase of 20%, which is pretty good, right? Sales return allowances. My base year, 2013, I started out with $5,000. In 2014, I had $7,000, so there's a difference of $2,000 for 40% increase. My total overall net sales was an increase of 16%. So now I'm going to go down here to cost of goods sold, and the cost of goods sold includes my purchases and my delivery charges. So, for instance, for my purchases for 2013, my base year, I had 1,750. I had more purchases in 2014, an increase to 2,100. The difference is 350, and it was an increase of 20%. Delivery charges also increased by 25%. So my overall cost of goods sold increased by 21%. So even though my net sales were up, my cost of goods sold was also up. How much it cost me to purchase those items, plus the delivery charge, and that's what I'm going to turn around and sell to get my net sales. So my gross sales profit was an increase of 16%. So let's go a little down here to expenses. I have rent, utilities, wages, fuel, and total expenses. So after I break each line item down, my rent increased, my utilities increased, my wages increased, my fuel increased, so my total overall expenses increased by 9%. So after I take my revenues minus my expenses, which is the income statement, correct? My overall difference was 1,490, or 10%. So if I was an analyst, and if this was my company, and I was looking at it, I would go for the ones that increased the most. For instance, I see 40% over here for sales return allowance. Well, what's causing that? That would make me think that's something that we need to dig into, because that percentage is pretty high as compared to all the other increases. So that'd be something I'd want to investigate. My delivery charges went up 25%. I'm not so sure I want to be maybe using that same carrier if it's going to go up 25%. So I might want to check into that. Okay, now here's a horizontal analysis for a balance sheet. And again, I just made up these numbers just to show you how it works. So I have cash and cash equivalents. I see that there's an $11,000 increase, or 6%. Accounts receivable decreased, so my cash increased, my accounts receivable decreased, so my accounts receivable decreased by 12%. Short-term investments increased by 24%. My inventories decreased by 25%, which can be a good thing, because if I'm decreasing my inventories, that means I don't have as much on stock, and if I don't really need to have that, then I don't need to tie up my money in stock that's going to sit on the shelf, right? Okay, so other current assets, and I got a total current assets of an increase of, what was the difference? A positive difference of 17,200, or 4% overall. Okay, so that was my current assets. So property, plant, equipment is not considered current; it's considered fixed asset. There was a decrease in my PP&E. And accumulated depreciation was also a decrease. Probably really should have been an increase, but let's go with that. So net property, plant, and equipment, I had a total decrease of 7%. My long-term investments, there was an decrease. Intangibles didn't change, and goodwill didn't change, and deferred taxes, 11% increase. So okay, so on the balance sheet, remember on the balance sheet, it's assets equals liabilities plus stockholders' equity. So here, because of the PowerPoint, I didn't want to smash it all in, so I just separated the assets. So our total assets, we have 1.1 million, 1.2 million, 1.185, I'm sorry, it's 1,185,000 in 2014 as compared to our base year, 2013, was $1,198,800. So there's a decrease of 13,800, or a negative 1%. So if I'm going to go next to my total assets, and if you can see, I took my total assets and just copied it on the top of the next page, so you can, so when we get down to the bottom, you can compare the two. So now remember the equation for a balance sheet: assets equals liabilities plus owner's equity. So now we have our liabilities plus our stockholders' equity. So we're going to show the difference here. We have a decrease in accounts payable, which is good, means we owe less money. So that when we decrease in liabilities, that's a good thing. Short-term debt increased, though, by 40%. Wow. No, I'm sorry. It decreased. Okay. So I see that we also made a few other decreases here. We decreased current portion of long-term debt. Income tax payable decreased. Other current liabilities increased slightly by 25%. So we have total current liabilities with overall was increase of 1%. That's current liabilities. Remember, current is within 1 year. It's only a 1 year. Anything over than that is considered for assets fixed assets, or for liabilities going to be considered long term. So we had no difference in our long term debt. We have deferred income taxes of no difference, and other liabilities there were no difference. So our total liabilities increased slightly 1%. Okay, so now our stockholders' equity. So we have preferred stock from 2013 was no change. Common stock par value plus additional paid in capital. It's a slight change of 828, or 8%. Retained earnings. Actually, retained earnings decreased. Treasury stock increased. We bought a little bit more of our stock back. And so our total stockholders' equity decreased by 3%. Now let's look at our total liabilities and stockholders' equity. It decreased the same amount that our total assets decreased by 1%. Okay, so here's the first assessment problem. It's a horizontal analysis for balance sheet. Now what I would like you to do is to take the numbers that I have on this PowerPoint, put them into an Excel spreadsheet, and then come up with the difference and the percent of difference. It's a very simple exercise. So down here where it says exercise in Excel, enter the information from the slide and calculate the difference. So I took little snapshots, and hopefully you're all familiar with Excel. If not, Wednesday night I have a chat, or if you're not doing this on a Wednesday night or prior to Wednesday night, you can call me on my cell phone. You might want to text me and let me know you're going to call me, so I can let you know when I'm available if it's not on a Wednesday night. But Tuesday's definitely out. Try not to call me on Tuesday. I probably would not be able to answer. But anyway, so if you are not familiar with Excel, at the column you have column LMN, and then you have rows. So if you see in column N where it says equal, to do a formula you have to do an equal sign in Excel. And I'm in that little cell, and I'm grabbing, what I'm doing is I'm taking L1, because I'm on column 1, column L, row 1, and I'm just clicking in that cell. I'm hitting the minus sign, and I'm going to minus out M. Alright, so that's how I'm going to get my difference. So I'm taking the year 2014, I'm going to subtract 2013 out. Then the percent of difference, though, I'm going to take, okay, so now I already have my N, which is, you see in this example right on the percent of difference, it's 52,127. So to get the calculation for the percent, I'm going to do my equal sign. I'm going to grab N1, which is the 52,127, and I'm going to divide it by my base year, which is going to be the 2013 year, and that's going to give me my percentage. All right, and carrying it over on the balance sheet over on this side, there's just a set of numbers you're going to do. You're going to do a complete balance sheet. I did condense it a little bit from what I did, just a few things, but this is not hard. If you know how to do formulas in Excel, it's not hard at all. You can copy and paste, or you can drag it down by the crossbars, except for when you do division. It does not let you do division like that. You will not get the correct number most of the time, so you might just have to do that by each cell. So I don't think this will take you too long, but if you do have problems, again, you can call me. All right, a vertical analysis is the proportional analysis of a financial statement where each line item on a financial statement is listed as a percentage of another item. This helps the analyst to understand what the percentage of each item that makes up the total amount. It's a good way to determine if the company should focus on decreasing or increasing a certain line item. And let me make that make sense to you. Okay, so here's an example. This is an income statement. So, okay, so if you see, okay, so let's go across the titles up there at the top. So we have the year 2014, then we have percent, 2013 percent, and then we have a difference. So if we see that our revenue, sales revenue, is $36,000 in 2014, and that's 100%. So now this is vertical. We're not going cross to cross initially. We're just looking at this year. What makes up my sales revenue? What's all the percent of all the other items as far as in regards to my sales revenue? So we're just looking at 2014. Don't look at 2013. I have my sales revenue is 36%, and that's going to be my 100%. That's what I'm going to take. I'm going to divide everything into that and see what proportion I come up with. So my sales return allowance of $7,000 is 19%. My net sales, $29,000, and that's going to be my $81,000. My 19 and my 81 is going to be my 100%. Now let's see how everything else breaks down. So I see cost of goods sold, or the purchases, was $2,100, which was 6%. Delivery charges, $250, was 1%. Cost of goods sold, after I add the two together, $2,350, is a total of 7%. So my gross sales profit or loss is 74%. Now all my expenses is compared, what percentage. So my rent at $3,000 is 8%, utilities at $600 is 2%, wages at $5,000 is 14%, fuel at $400 is 1%, and total expenses overall $9,000 is 25%. And so my net operating income is 49%. So now if you look at year 2013, the numbers don't change, and I did a difference here. Most of your academic books do not require that you do that. I think that is a good way just to determine, even after you do your vertical, because it's your vertical, and you're just comparing what components make up your total. For instance, an income statement would be of your sales revenue, but I'd like to see the change from year to year. And in this particular case, you have very little change. So I know that my sales revenue, there was a 2.78% change. Gross profit was 2.81. And if I look down into my expenses, very small, excuse me, very small changes, very small. Total expenses overall was a increase actually of 2.52%. So it was not much at all. All right, so here's our vertical analysis for a balance sheet. And so when again, I had to break this up, and I did it according to the equation so it makes sense. Assets equals liabilities plus owner's equity. So here's my assets section. And I took all my different items, cash and accounts receivable, short-term investments, inventories, other current assets, for total current assets. Okay, and I added them all up. And those were actually 39% of my total assets. And if you see at the bottom line there, the $1,185,000 is my 100%. So 39% of that is my total current assets. The remaining is going to be my fixed assets. And I did the same for 2013. There's very little change between the two. You can see that I had to carry it out a couple decimal points to even see that I had a change. So most of the items were less than 1%, which is good. But it still gives me, as an analyst, an idea of what's going on. And here's my liabilities, same thing. Now remember, the equation is liabilities plus stockholders' equity. So my I had to take my total, and I didn't put the 100% signs down here, but it said at the very last line, total liabilities and stockholders' equity, that $1,185,000 would be your 100% for 2014, and the $1,198,800 would be your 100% for 2013. Very little change from year to year. But as an analyst, I want to see that. I want to see what's really causing an increase or a decrease, so that I am aware of it, so I can, if it's not a good increase or decrease, I can focus on it and say, well, we need to improve this or we need to improve that. Because whatever you focus on, or whatever you put attention to, will get better. Rule of thumb, anyway. Okay, so question number 2, assessment problem number 2. You're going to do pretty much the same thing that we just did in Excel. You're going to take the percent of each line item to sales, 100%, and then the difference from 2014 to 2013. And what I would really like for you to do too is to kind of notice the red flags. There's a couple in here that increase or decrease more than just a few percentage, and they stick out like a sore thumb. So you might want to just add that to your a problem statement down here.